Welcome to another episode of Sanlam's In Conversation podcast edition, where we dive into the most important trends and issues affecting the employee benefits landscape. I'm your host, Ulitile Ramashala, and today we're tackling a topic that's created a lot of conversation, some might even say confusion, in South Africa over the past few months, and that is, of course, the two-pot system. I'll be joined by a team of experts to take a holistic look and share insights on the implications of the newly implemented two-pot retirement system on a range of issues, including retirement planning, investment options, fund administration, divorce, and so much more. As you know, this system introduces a more flexible approach to retirement savings, allowing for immediate access to a portion of funds while keeping the rest safely invested for your future retirement. But with these new rules comes a host of legal, administrative, financial, and economic considerations. So whether you're an employer, a trustee, broker, or advisor, or just someone trying to understand how this system could impact you and your future, this episode has something for everyone. On that note, let's get started. I'm thrilled to have Mr. Arthur Kemp, our chief economist at Sanlam, who's joining me now to discuss the broader impact, or economic outlook rather, and the potential impacts on the two-pot system on investments, financial security, and South Africa's economy as a whole. Welcome, Arthur, and thank you for joining me.
Hi, Olatilwe, and thank you so much.
Yeah, let's get started, Arthur. In your view, how do you think the introduction of the two-pot system has impacted the South African economic climate?
Well, I think on margin, not too much yet, really. I think the impact is still to come. We have seen consumers more confident in the third quarter. Surveys showing businesses more confident, but I think that's got a lot more to do with the formation of a government of national unity and an expectation that economic reforms are going to get underway and that the economy is going to grow faster. And for the time being, if we can get the economy, for each 1% additional growth we can get out of this economy, you're creating more than 100,000 jobs. I think that's what's potentially exciting. But two-pot is there, and its impact is still coming over the next year.
Wow, that's true. And since the implementation on 1 September, Arthur, have we seen an increase in consumer spending? And could this impact inflation, even interest rates going into the future?
Too early to tell. The latest data we have, if you look at the retail sales data, for example, from Statistics South Africa, we've got the July data print. That came out in September. So in October, we're only getting the August print. So it's going to be a couple of months before we know. But we know the impact's going to be big in the fourth quarter because there are lots of estimates out there. And I've seen estimates of the total withdrawals potentially initially amounting to anything from 30 billion to 100 billion. Sure. But let's take the 100 billion, which is a high-end scenario. After tax, you could be looking at 70 to 80 billion rands worth of personal disposable income boost in the fourth quarter. We don't know how much people will use of that for spending, how much they would use for paying off debt. As I say, there's a big range of how much the withdrawals will be, but nonetheless, that's bound to show up in consumer spending.
Sure, Arthur, that's quite scary. 30 billion to 100 billion. That's quite interesting. It's probably too early to speculate, but in your opinion, how do you see the two-pot system impacting monetary policy, particularly in terms of interest rate adjustments?
So I think over the next year, if we take, even at the high-end scenario, up to 100 billion rands worth of withdrawals, and you take the after-tax amount of that, plus obviously access to the third contribution to savings pots over the next year. Even if you took that scenario, which is a high-end scenario, then in terms of after-tax spending and the overall boost to the economy, remembering that we still import goods, so if you consume, we still import, which subtracts from GDP, you're getting a contribution very lumpy in the fourth quarter of this year, but overall for 2024, maybe an addition of 0.25% of GDP growth. Next year, another 0.5% GDP growth. That's at the high end of assumptions. And, that's probably not enough to create upward pressure on inflation, or a lot of it. Very, very limited, I think. And therefore, I would doubt that puts upward pressure on interest rates, remembering that we are now what seems to be in a significant interest rate cutting cycle, barring accidents. And then there's the other side of it. The government's going to get their tax contribution because these withdrawals are taxable. And that could amount at, again, high end of the assumptions of about 0.5% of GDP, smaller budget deficit. And the impact on the debt ratio is even higher than that because it's a smaller budget deficit and GDP is larger given relative to the existing stock of debt. So that relative to baseline, the debt ratio doesn't go up as fast anymore. And remember, all else equal, that's also a contribution to where real interest rates are sitting in the economy. So I think on balance, this isn't going to have a material impact, probably a very marginal impact, if that, on interest rate decisions.
Interesting views. And then from a behavioral economic perspective, how might this new system change the way people approach retirement planning? And will the option to access funds early lead to more withdrawals in your view? And what could be the short, medium and long-term economic impact of this?
I think in the long term this does change savings behavior. So if we look at the retirement industry, total contributions a year around 250 billion rand in that region. Withdrawals around 360 billion rand. And the Reserve Bank recently published a paper on the two-pot system, and they indicated in there that more than 100 billion rand of that 360 billion rands worth of withdrawals is resignations. So what you could get, of course, is less, let's put it this way, incentive to resign to access those funds if you're in an emergency. And then, of course, in the long term, what happens here is that because 2/3 of your contributions are invested and you have access to a third through the savings pot, over time that improves savings behavior. So I think in the longer term, this actually on margin should actually improve savings behavior and improve the number of people who can actually retire relatively more comfortably than what is the case now. Of course, what that also does in the very long term is it places less pressure on our fiscus because a high level of unemployment in South Africa today, if you get the government of national unity going and we get economic reforms going and faster growth, we employ more people, plus better savings behavior, that's much less pressure on the government. And because you can see that pressure coming through in social grant spending, which we have to do because you have to support a population that's in such dire straits. But those pressures then one would envisage in the long term start to ease off. In the near term, though, of course, you're going to see significant withdrawals and probably quite lumpy up front. So this is a long-term process.
Couldn't agree more, Arthur. I mean, I think you've touched a bit on it, but I'm going to ask this question regardless. If we see a significant shift in savings behavior or lending trends, could the Reserve Bank then respond by adjusting interest rates to encourage or discourage borrowing?
So if we look at interest rates, there's in the short term, monetary policy is very important in the formulation of interest rates, but in the long term, ultimately, interest rates in the economy are a function of the interaction between savings and investment. So if you think about South Africa at the moment, we've got pretty high real interest rates. And we've got quite high real interest rates in large part because we've got a government that is running large budget deficits, has a high debt ratio, and is absorbing a lot of savings, and that's putting upward pressure on real interest rates. So it's on margin, if you improve the savings behavior of South Africans, then and savings generally improves. And remember, we've got a government now that if we manage to grow the economy faster and we over time start to improve our fiscal position and government starts to absorb less savings relative to GDP, plus you're improving savings behavior of households, that improves overall level of savings, which all else equal puts downward pressure on real interest rates structurally over time. So one would hope that that is the case here. At the same time, we also at the point where I think that in the next few years, if everything goes according to plan and we stabilize fiscal policy, and at the same time that would obviously help bring down real interest rates and create more space for the private sector to take on debt, you might well find that private sector borrowing over the medium to longer term actually picks up. But that would be to hopefully invest and drive the economy. So I think that we need to see this in the perspective of structural forces. All else equal, you improve savings behavior, that puts downward pressure on real interest rates. But we have to then obviously play that off against the fact that South Africa is quite far behind on its investment spending and infrastructure. There could be a lot of demand for investment in that. And over time, if you lift investment strongly, that would tend to put upward pressure on real interest rates again. So you've got to balance these all out. But, to fund investment, the bottom line is you need more savings. So all in, I think this is a good development.
Wow, that's really, really good. And with individuals potentially using their savings pot to avoid taking on new debt, do you foresee any impact on lending markets, such as reduced demand for personal loans or credit? Or could we see lenders rather adapting to new behavior, to new borrowing behavior?
very hard to tell. If you look at the amounts here, even if you're talking at the top end, the sort of estimates of 100 billion rands worth of withdrawals, to put that into perspective, total household credit is standing at about 2.9 trillion rand. And from bank lending, it's about 2.2 trillion rand. So yes, at the moment it's growing fairly slowly. Over the past year, increased by about 65, 66 billion rands worth of lending from banks. So if you take that 100 billion, that's, it's quite big in relative to the perspective of how much debt people have been taking on. But we don't know how much of the 100 billion they'll use to pay off debt or not take on new debt. Very difficult to tell, but I think those numbers sort of put it into perspective that it's not that big in the context of the entire amount of borrowing. For certain individuals, it's going to make a significant difference, obviously. But in aggregate, I don't think it's from that perspective that big.
Okay. And Arthur, is there a risk that individuals might continue borrowing while simultaneously withdrawing from their savings pot, leading to over-leveraging? And how could this scenario impact the stability of credit markets?
So I think the consumer at the moment, if you look at the level of debt to personal disposable income, it's not much higher than 60% of GDP. If you look at the debt servicing cost as percentage of personal disposable income, it's obviously been rising because we've come out of a rising interest rate environment, had our first interest rate cut now in September. But it's not that high relative to history, certainly not anywhere near what we, for example, saw during the global financial crisis, where that debt service cost got over 12 to 13% of personal disposable income. It's materially lower at the moment. And if we're right, barring accidents, geopolitical risk, the rand falls when inflation is a bit higher than we would like it to be again, and that impacts monetary policy decisions. But on current information, with the Federal Reserve cutting interest rates, with inflation heading lower in South Africa, there's significant scope to cut interest rates, which means that debt servicing cost is going to be coming down. So it is a time now where you would expect consumers to take on more credit. Obviously, if you have access to this type of funding, the previous question we discussed that this is not that big in the context of the overall level of lending. But for certain individuals, they may take this money in lieu of taking on additional debt. Or alternatively, you might find people at this stage of the cycle, if interest rates come down far enough, people haven't been, if buying durable goods for a long time, they might decide this is a good time to do it. They might look at a home, I don't know, and you may use some of this cash as a deposit on an asset. But it is a stage in the cycle where I would expect consumers to take on more debt, and with interest rates coming down, the affordability of that should improve. And as I've said, I think we're in a period the next few years where if we do see over time the government debt ratio stabilizing and eventually coming down, if we do get to that point, government absorbing less savings, if fiscal policy stabilizes, you could find that the risk premium priced into South African interest rates is reduced, so interest rates come down. That could be a natural period for the private sector, both companies and individuals, to borrow more anyway. Of course, for individuals, their individual circumstance would differ, but I would see it that way in aggregate.
Okay, thanks, Arthur. And lastly, are there any international examples that stand out as example for South Africa to learn from? And if so, what lessons can South Africa learn from the economic outcomes, particularly concerning savings, lending, interest rates, and inflation?
Now, the popular one is Chile, because Chile saw a very high level of withdrawals. I mean, we're talking about round about 1% of GDP, a little bit more. Potentially at the high end of withdrawals. In Chile, it was 14 times more as percentage of GDP. So you saw a very big boost to consumption. It happened in late 2021, early 2022, when the economy was recovering from COVID. So it was growing very, very strongly. So it was difficult to pick out how much of this impact, the growth in GDP, came from the withdrawals, but they were big. And obviously the tax take was also quite significant. But it got to the point where the government then actually stopped it because the pension fund assets were declining, and it had an overall, from that perspective, savings perspective, obviously a negative impact. So that sort of, with those amounts of withdrawals and the kind of spending that would come from that, one would imagine in an economy like ours, where our potential growth rate is still quite low, and you put that amount of demand on it, then that could potentially put significant upward pressure on interest rates through higher inflation, prompting but the way ours is structured, we're not talking about that type of a scenario. Okay. I think that given the rules of our system, I think that, as described earlier, don't think it's going to have an impact. We're going to see it, certainly in the fourth quarter on a quarterly basis, and there'll be some impact, but not big enough, in my view, to change the overall big picture for the South African economy like that.
Okay. Well, thank you so much for joining us, Arthur. I certainly learned a lot from your views, and look forward to having you again.
Thank you, Olatilwe. Appreciate it.
Thank you so much. Well, that was Mr. Arthur Kaplan, our Chief Economist at Sanlam. Thank you so much for taking the time to join us. Joining me now is Johan Prinsloo, Head of Retirement Fund Administration at Sanlam Corporate. Johan has been at the forefront, leading diverse multifunctional teams of professionals and experts over the past few months, preparing, of course, for the two-part system go live. Johan will walk us through some of the administrative readiness and the operational changes that were implemented leading up to 1 September, which I might add, yes, there were glitches here and there, but Sanlam Corporate was among the very few that were able to process payments within the first week. A massive and commendable achievement. On that note, well done, Johan, and welcome.
Hello, Olatilwe, and thank you very much for having me.
Thank you for joining us. So let's kickstart the conversation, Johan. So you've led Sanlam Corporate through the implementation of the two-part system with just over a month since the go-live date. What has been your experience thus far? Key learnings, strides made, and the challenges?
So, Olatilwe, we know that the two-part system is a complex change in the retirement fund industry, in so much that it affects all process from a retirement fund administration perspective. And then it also introduces new processes, which is the cash withdrawal from the emergency savings pot. And if I can perhaps, just from a challenge, from what consumed quite a bit of time in the project, it was definitely the system development, with a lot of focus on how we're going to implement the cash withdrawal from the emergency savings pot. And then I think the other massive component was the change management. And that ranged from internal training, getting staff up to speed with the two-part changes, but then, of course, more importantly, also our clients. So that is our boards of trustees, our intermediaries, our participating employers, and our members.
Shoo, Johan, well done. It seems like you had your hands full.
Definitely been a very busy, I guess, a year and a half now, almost, that we've been working on two-part.
Wow. Now, I think many members who decided to withdraw didn't fully grasp the tax implications of withdrawing, right? Can you unpack this just a little more, and what are the tax implications that people need to be aware of overall?
Yeah, so I think firstly there was in the initial stages confusion as to which rate, tax rate, SARS will use when making a cash withdrawal from the savings pot. And the answer to that is, as a reminder, that it's your marginal tax rate. In other words, the same tax rate you pay on your salary, you will pay when you make a cash withdrawal from the savings pot. Also, what I think members did not realize, that if your taxable income is borderline to a particular tax bracket, and you make a cash withdrawal and that pushes you over to a next tax bracket, you may be taxed at a higher tax rate. And then a big surprise that came around, I think here in July or so, was the confirmation from SARS that they will also recover arrear tax or tax debt from the cash withdrawal from the savings pot. And from a statistical perspective, if we say we've seen just over 90,000 claims being referred to SARS for a tax directive, and just under 10,000 of that actually had arrear tax on them. And then we have the unfortunate scenario where 1,200 of members received zero payment of their cash withdrawal because the arrear tax exceeded the amount they were able to withdraw. So that is very unfortunate, and what we do encourage members to do is please check your tax account on e-filing, see if you have arrear tax, because it will be a nasty surprise if you have arrear tax and you think you can make a cash withdrawal and then there's nothing to withdraw.
Sure, I think that's very important, Johan. Sad reality, but very important indeed for members to check their tax status before being tempted to tap into that withdrawal.
Absolutely, Olatiwe.
So, Johan, if I submit a withdrawal request and I realize that the tax is too much, or I suddenly change my mind about withdrawing, can I cancel this request?
So that's the other downside of making a cash withdrawal from the emergency savings pot is in the Sanlam world, 99% of our claims is processed digitally and is automated. So once you submit a claim, you cannot withdraw it. It's going to go through an automated process, and also once it gets to the tax directive application process, and that tax directive application is made to SARS, we're not allowed to reverse that tax directive application. We by law obliged to see the process through. So the short answer is no, you cannot reverse.
Sure. So it's important that members are aware of this and that
Please
they
check
definitely check before pressing that button.
Yeah.
Okay, well, so when changing jobs or during retrenchment, how is a member's retirement funds managed within the two-pot system?
All right. So perhaps just to reflect on the situation as it was prior to 1 September. So prior to 1 September, we all had what we call a vested pot.
Yes.
And at resignation, you could take that entire vested pot in cash if you so preferred, or you could preserve it in the fund, or you could transfer it to another fund. Okay. Now you've got two new pots added to that, which is the emergency savings pot and the retirement pot. So post 1 September, you can still take your vested pot in cash or preserve it or transfer it to another pot. If you haven't made a withdrawal from the emergency savings pot in the same tax year that you terminate your employment, you can make a withdrawal then. Otherwise, you're barred from doing it. And as we know now, the new rules applicable to the retirement pot is that you have to preserve that retirement pot. You cannot withdraw it at resignation. You can only touch that money at retirement. And that you need to use to purchase an annuity. There are rules applicable. For example, if it falls below a certain minimum amount, the entire benefit can be taken in cash, but likely in most cases you will have to purchase an annuity with your retirement pot at retirement.
Got it. And on the theme of members' understanding and communication, how's Sanlam Corporate ensuring that members understand the changes and know how to interact with the two-pot system? Have there been any concerns or misconceptions raised by members? And if so, what are some of the strategies we've put in place to engage and educate our members around the two-pot system?
Okay, so as I mentioned earlier, a very big part of the project was change management, and especially how two-pot impacts members, especially the cash withdrawal from the savings pot, but then also when you resign or you retire, what are your options in those events? So I think what we've come to realize is, and although we did a lot of education and training beforehand, we had a multifaceted or a multimedia approach. So we did posters in canteens, we did videos, we did webinars, in-person training, training through intermediaries. You know, we had to adopt the approach of train the trainer, because there's so many members affected that, you know, a core team in Sanlam couldn't possibly do the job, so you had to pay it forward, that knowledge, and train the trainer. So that was a multi-pronged approach. But what we've come to realize, given the complexities of two-pot, is that training is going to be an ongoing thing. And it's probably going to take, in my personal opinion, the better part of 2 years for this to be fully immersed into our member base. I think the difference we see now is where in the past there was a lot of member apathy towards their retirement savings. Now that members has the opportunity to make a cash withdrawal from the savings pot in order to alleviate financial distress, there's now a lot more proactive engagement from members towards the retirement savings, which we of course as an industry welcome, but with that comes the responsibility to help members understand what this new world of two-pot needs.
I like that. And that method of train the trainer is a very, very, very clever and innovative strategy that we've done, Johan. And this is the most that members are interacting with their benefits. So that's also a positive on our side.
Huge positive. We know we've been struggling with member apathy in the industry in the past, and now we see that almost being turned on its head. If I can just recall one statistic, our web registrations increased by over 750%. Wow. Compared to previous statistics before the advent of two-pot, which we are of course very glad about, because we are here to help members retire comfortably, and that is a two-way street in engaging and interacting with members.
Okay, so now let's talk numbers, volumes and traffic so far. What was the estimated value of claims the team had anticipated versus where we are now?
So it was really pretty much a guessing game. As you can imagine, because this is an unprecedented process, the cash withdrawal from the savings pot, we had no precedent to fall back on, so it was just all speculation. So, but now, at least now that we're a month and a week into the new dispensation, we do actually have some actual stats that we can share with the audience. So up until Monday, this past Monday, we've processed or received over 93,000 claims, of which 99%, as I mentioned earlier, has been submitted via our member portal. The average claim is about 20,000. The value of these 93,000 claims is ticking up to the tune of 1.8 billion. And we've paid out net value after deduction of tax and that sort of thing, 1.2 billion. And of that 93 million, we've referred 89,000 to SARS. So just on an ongoing basis, I think in the beginning, the early days of September, we saw about 7,000 claims per day. And if you consider that...
Per day,
and if you consider that Sanlam Corporate processed 5,000 claims per month, in terms of normal resignations and retirals, that is a massive change from an administration perspective. So that 7,000 claims per day slowed down to about and stabilized at about 3,000 claims per day.
Okay. I was about to just actually, that goes nicely into my next question, because I was going to say we saw large volumes of claims at the start, and now you've just said it's slowing down. What type of movement or trend are you anticipating over the next few months?
We do expect, we did always expect a rush. I think what it comes as a bit of a surprise is that the rush is a little bit prolonged. We expected it to tune down quite a bit towards the end of September, but that high pressure, if you look at the calls we're receiving in our call center and via our WhatsApp lines, there's still a very high rate of traffic, queries coming in, because I think members that now struggle a bit with registering on the member app and actually making cash withdrawal, or smaller groups being in a bit of an anomalous phase, like for example a Section 14 transfer group of members is now coming to the front, and that's generating quite a bit of queries. But we do expect the trend to go down as time progresses. We also do expect a possible uptake in December, although we don't hope to see that, because members are supposed to only make a cash withdrawal for financial distress and not to pay for a holiday. Then we do also expect to see a possible uptick at the start of the school term in 2025, and definitely an upturn at the start of the new tax year in March 25.
So it just goes to show that some South Africans are under a lot of pressure, especially if you're foreseeing next year with school pressures, etc.
I do think that the high number of claims is a factor of financial distress that citizens in general experience, because it's not just at Sanlam, it's across the board where there are high volumes of claims, and I would think that that is a factor of the economy.
So, I mean, touching on the previous question that we've just talked about, how are we at Sanlam Corporate adapting to potential seasonal or cyclical increases in volumes going forward?
Look, I think we in the fortunate position where we have the capability to process large volumes of claims on a straight through automated basis. So cyclical changes won't affect us so much. I think the challenge we saw in the beginning when we went live with Two-Pot was the bandwidth and the traffic that came through firstly the member portal, then we've got what we call a security gateway that sort of validates the user from a security perspective, and then the user comes through to the Sanlam corporate environment where they submit their claim. Now the processing capacity of the servers as well as that gateway had to be made bigger on a couple of occasions to allow for the traffic. And I think with that, those lessons learned, we are able to anticipate and cater for high volumes in cyclical events across or during the course of a particular year.
Wow. And I think that's a massive on you, because like the 99% that you mentioned earlier, digital submission, that's massive for us at Sanlam Corporate. So
yeah, we're very grateful for that it's worked out, but it did take a lot of planning, a hell of a lot of workshops. But I'm so pleased and proud that it's reaped the rewards we were planning for.
100%. And then are there a number of steps and processes leading up to a member submitting a claim withdrawal? And these steps involved different stakeholders. So talk to us about the role of employers and advisors in terms of processing claims or providing support to ensure a more efficient process. What are the challenges that you currently face?
All right. What we realized very early on in the project is that Two-Pot is so big and the change is so massive that one service provider in the end-to-end value chain cannot do it alone. We need the support of participating employers and our intermediaries and boards of trustees in
the
order
concept train the trainer.
exactly to make Two-Pot a success and to continue to immerse it in our member base. As I said, I think it will take some time before members fully grasp and understand the impact of Two-Pot. And with that change management, it's not just a Sanlam as an administrator that can pull that off. It is a shared responsibility, I believe, with the employer, with intermediaries and service providers to help assist with that change management. And as I also said, it's ongoing. I don't think it's something that stopped on 1 September. It's definitely something that's ongoing. And then the other thing is especially with these smaller groups of members now coming to the front wanting to make a claim from the emergency savings pot, we did create a or a couple of channels through which a member can submit a claim. The first one, as I mentioned, is via the member portal, where the member just needs to register and then submit the claim themselves. We added a challenge with bank account details. So what we asked there was for employer to preload salary bank account details of members and for us then to pay into that bank account, because in the occupational fund environment we don't FIC our members or their bank account details, because that's not how we set up from a retirement fund administration perspective, but we had to get bank account details from a reliable source in order to effect the payment of the emergency savings pot withdrawal.
That's a good method to just control the cyber
So there was quite a
security.
huge fraud risk that we had to bat one or the other way. So that was the one thing we asked of our participating employers. And then we also saw in our engagements with our clients that some employers preferred to control the process or to oversee the process of making a cash withdrawal from the savings pot, and they preferred to, submit that claim on behalf of their member.
Okay.
And that's why we created that channel additionally for the employer to submit on behalf of a member, either where the employer expressed the desire in terms of the employer or employee value proposition to oversee that process on behalf of the member, or where the member is not able to submit a claim themselves, they can also approach the employer to assist with submitting a claim.
Sure, so we really need to walk this journey together.
Absolutely, I think it's crucial.
Wow, Johan. And then lastly, is there something interesting that wasn't anticipated at all that you've seen emerge from the first month after the system where we went live with Two-Pot?
Well, Olatiwe, you know that members who were 55 years older on 1 March 2021 and a member of a Provident Fund and still a member of that same Provident Fund on 1 September 2024 were excluded or not auto-enrolled into the Two-Pot system, and they had to opt in. And because now, 3 years later, those members are now 58 and above, we didn't expect those members really to enroll into the Two-Pot system. And what we've seen, and what was the surprise, although we have the functionality on the member app, we had to extend that functionality to the employer portal as well, because there was a surprising uptake by these 55-plussers to roll into Two-Pot, which again I think demonstrates the point about financial distress, members being so close to retirement, still wanting to access their retirement savings before retirement, even though they're just a couple of years away from the retirement. So, of those 93,000 claims that I mentioned, it's not a big number, but it's a lot more than we expected. We saw about 1,000 of those, of 55-plussers that opted in.
Sure. Well, thank you so much, Johanna. This has certainly been interesting, and I've certainly learned a lot about what we've been doing to navigate around our Two-Pot system. So thank you for joining us.
And thank you for having me, Olatiwe.
Well, thank you so much. Ladies and gents, that was Mr. Johan Prinsloo, our Head of Retirement Fund Administrator at Sanlam Corporate. Thank you so much for joining us here at our Sanlam in Conversation podcast with me, your host, Ulidilo Ramashala. Until next time, goodbye. Beyond withdrawals and claims, which has been a big focus in the media space, there are legal implications that most people may not be aware of. Like, how will this system change the division of retirement assets during divorce? What does it mean for long-term retirement security, especially post-divorce? To help us understand the ins and outs of how pension law intersects with family law is Lisa de la Harpe, our Senior Legal Advisor at Sanlam Corporate. Lisa has been instrumental in sharing her expertise online and in media and when needed to simplify and help us understand the legal implications of the Two-Pot system, especially when it comes to how it affects divorce settlements and compliance. Welcome, Lisa, and thank you for joining us so much. So let's get started. We've seen a lot of Two-Pot awareness content shared by you, Lisa. From a legal perspective, what are the most significant changes that the Two-Pot system introduces when it comes to divorce proceedings?
To put it on a high level, I think the minute you think you say something like, what did it change? People think, oh gosh, can I not claim anymore? You can still claim from it. It is still taken into account by the court when they calculate the patrimonial assets to divide. There's at the moment a little bit of a contradiction between the Pension Funds Amendment Act and the Divorce Act as to how you calculate that, which is creates a little bit of legal uncertainty, because you could actually have differences in the calculation of the pension interest when it comes to how divorce lawyers apply it. But in essence, you can still claim from the retirement fund. In certain instances, obviously, if it's not the case of that you're entitled to claim. It depends on your marital regime, etc. But the same requirements that still apply. You have to your order has to specifically meet certain requirements. Otherwise, it's not enforceable against the fund. That's why it's so important to make sure that the lawyer that you appoint understands pension law, especially. Other than that, the impact that we didn't have before, obviously, is on the savings withdrawal, emergency savings withdrawal part. But I do think we cover that a little bit later.
Yes, actually. So what should divorcing couples be aware of when it comes to splitting of their retirement savings? Well, all the pots. I mean, we've got vested, we've got emergency and savings, and the retirement pot. Will this be equally, divided?
Yes.
subject to divorce settlement.
Yes, the deduction that's going to be made will be deducted proportionally across the 3 parts.
Okay, that's good to know. And then pre-divorce, because I think there's pre, post, during.
Yeah.
So let's start about pre-divorce withdrawals. If one spouse decides to withdraw from the savings pot before the divorce proceedings, how could that impact the settlement process?
Yeah.
Will courts take pre-divorce withdrawals into account when dividing the remaining assets?
So I'm going to answer you this way. The way the Pension Funds Act is worded is a fund can only give effect and pay out the money that's actually available. So if you had a divorce order, for example, saying I signed 100,000 Rand to my ex-spouse, but at the time of the divorce being granted, you only have 80,000 in the fund can pay no more than with the actual benefit that they hold on behalf of the member. And obviously, because of the fact of in terms of the new 2-part system, members will have the right to make a withdrawal once per tax year from this emergency savings pot. The legislator envisage this situation where you can have a divorcing party with malicious intent go and make a withdrawal, and at the moment the savings pot, obviously the value is still quite small. We've just kicked off with this, but in a few years it's going to be a third of your total contribution. So it does specifically, the legislation as they've amended it to cater for 2 parts, specifically states that if a fund is made aware of the fact that divorce proceedings have been instituted, they are not allowed to pay a savings withdrawal claim without the non-member spouse's consent. So for people in the process of getting divorced, I think it's very important to make sure that you notify the administrator of the fund of your spouse and from who you intend to claim that these divorce proceedings have been instituted, so they can put a hold on the savings.
And if they don't, then that means the other member could be liable to pay while as soon as the divorce is started.
Yes, but that would be a claim that you would have against your spouse and not against the fund, because like I said, the fund can pay no more than what they actually hold.
Got it. And so now post-divorce, shifting to retirement planning, what advice would you give to individuals going through a divorce when it comes to safeguarding their future retirement securities under the 2-part system?
I think if I can give advice in the sense of, we do tend to refer to settlement quite often when we talk about divorce. And I think it's important to remember, if everybody was mature and almost want to say financially savvy, it is always the best thing to settle a divorce matter. It's very expensive. It's very long-winded. At the end of the day, the attorneys win more than most. Probably a contentious thing to say, but having practiced myself, I do know how the charge systems, if I can put it that way, practices work, and it can really be a very long, drawn-out process, which is not good for anybody involved. Is if you are in a fortunate enough position that you are entering into settlement negotiations, in the sense of there's not the intention to go to trial, I think often people tend to see this as an easy way to settle who owes what kind of a thing, because it's normally, for many people, it's their biggest asset. But you have to think about that long-term impact that has. In essence, let's say you are married in community of property, and this is one of the pension interest is one of the assets you're going to split down the half. That's half of your retirement savings. And people, tend to get divorced a little bit later in life, which means that the years you have left to make up for that payment is limited. So I think it's something that people should carefully consider, not, jump to that as that's the easy one because you don't feel the impact now.
Because there's long-term implications if you don't do a thorough, okay.
And then maybe one thing to add as well, the non-member spouse in terms of the Pension Funds Act, they have a choice. So let's say, for example, I'm the non-member spouse and I was awarded 50% of my husband's pension interest. I have the option to take that 50% in cash or to transfer it to another approved fund. If you take it in cash, you're going to pay tax on that. And in that sense, if you transfer it to another approved fund, it's going to be tax neutral. And that is a good way to make sure for your own future retirement savings that, especially since you'll now be a single woman with one income. So those kinds of things are important to consider. Not be tempted to take that out in cash and go maybe settle debt or because you're going to pay a lot of tax.
That's very good advice. And then fund governance and compliance. So what new responsibilities will pension fund administrators have in terms of managing and enforcing divorce settlements under the 2-part system? Are there specific challenges they need to prepare for?
Well, what's completely new is the fact that you now have this restriction on savings withdrawal claims where divorce proceedings have been instituted. Previously, before you have a divorce order in place, the fund, first of all, is not going to know. And secondly, before the order is actually granted, the non-member spouse has no right to anything yet, if I can put it that way. There's now this new requirement on the obligation on the fund to suspend a savings withdrawal claim where they know that there is divorce proceedings instituted unless the non-member spouse consents.
Yes.
So you definitely have to make sure from an admin perspective that you have the capability to make a note, I want to say, on the member's record to make sure that you keep this in place. Similarly for maintenance orders as well.
And what about the impact on dependents and beneficiaries? How does the two-part system affect beneficiary designations post-divorce? Are there legal guidelines or best practices for updating beneficiaries post-divorce, especially when dealing with two separate parts?
I think in that sense, it's not necessarily a two-part change. I think it just again highlights the importance of understanding how death claims are handled by funds. Lump sum death benefits have become payable as a result of your membership. So typically you have the option to nominate a beneficiary, but I think what's different to the approved risk benefit kind of space is that the trustees are not bound by your beneficiary nomination. So it's one of the factors, one of many that they will take into account. But at the end of the day, dependency is key. So in terms of how the act is worded, they have to identify dependents that's specifically defined, that are those that were dependent on you or would have become dependent on you. So if you have something to bear in mind is if you get divorced and in terms of the divorce order you have an obligation to pay your ex-spouse maintenance, just bear in mind the fact that you're no longer married doesn't mean that automatically you're not going to get anything from your death benefit payable when you pass away. They will still qualify as a legal dependent in terms of Section 37C. So that's just maybe something worth noting.
Okay. And will the two-part system affect how maintenance claims are calculated in divorce proceedings, especially considering that one spouse might have access to part of their retirement savings through the savings pot?
Let's answer that on the divorce one, because that's the more complicated one. I mentioned at the outset of our chat that there's a little bit of legal uncertainty at the moment. So without going into too much detail, because I think it's only us lawyers that find it super interesting, but I've written quite a bit about this as well, is how pension interest is actually calculated is set out in the Divorce Act. So when you approach a court for a divorce order, obviously the court has to turn to the Divorce Act to give the parameters of what are orders that the court can give. And there's how it's always been worded and still is that it would be the benefit that the court takes into the calculation is whatever amount you would get if you resigned from employment today and your membership came to an end. So obviously we know before that would be whatever was in the fund if you were, let's say, a member of a pension fund. Now that's not the case anymore. You can't get your retirement pot. So what they did is the legislator went and amended the Pension Funds Act and inserted a new definition of pension interest that takes into account this nuance in the sense of to still keep it that you calculated according to the whole fund balance, because obviously that's the intent. The problem is that we're sitting with a situation where we're not sure how lawyers are going to apply it. They might be following the Divorce Act definition, which hasn't changed when they work out calculations and advise their clients, which means the settlement amount percentage that they help their clients come to might be less or more, depending on which definition you're going to go with. So unfortunately that it remains to be seen how the courts are going to interpret that. Then with regards to maintenance, what we have seen as a change is a new section's been added where that actually refers to future maintenance that can also be payable. However, I must tell you, there's court cases on this that the Maintenance Act does make provision for future maintenance. So I think you must just have an attorney there that really does have very good experience in the Maintenance Act and the legislative provisions there, just to make sure that you don't end up sitting with an empty order that you can't actually enforce.
Sure. I think you've said a mouthful, Lisa. I've certainly learned a lot. It's not only lawyers that be interested. Trust me, this is really, really, really insightful and educational. So thank you so much for taking the time to be with us and simplify this what seems to be complicated. And it's just so interesting to note and see how two-part actually affects everyone. It's not brokers. It's not only brokers and advisors and members, but it's also lawyers as well, because all of these things are intertwined. Absolutely. So thank you so much for joining us, Lisa.
Welcome.
Well, that brings us to the end of this episode of Sanlam's Corporates in Conversation podcast edition. A big thank you to all our guests for breaking down the complexities of the two-part system and sharing such invaluable insights. If you have any questions or would like to explore this topic further, feel free to reach out to us or visit our website on www.sanlamonline corporate for more information and resources. Until next time, from me, your host, Ulitilwe Ramashala, stay informed and stay confident.